Hello and welcome to another episode of Integrity365 Financial Insights Podcast. I'm Nicola, Independent Financial Advisor, and I'm joined today by my colleague Doug, an advisor and also a pension transfer specialist, to discuss managing the modern day pension. In today's episode, we're going to discuss some of the benefits of engaging with your pensions, tips to help you make the most of your pension, and the available tools and options in the modern day pension market.
Hi, Nicola. It's good to be joining you today. And yes, we are going to be talking about personal pensions, defined contribution pensions. These are typically your workplace pensions. So we're not going to be talking about the more complex final salary or defined benefit pensions. These are your more bread and butter pensions that you see in the world today. Typically, if you're not in the public sector and you join a private company, these are the type of pensions that they will offer you to join in your employment. So, Nicola, to kick us off, what are the main factors that contribute to an individual's benefits that they will receive in retirement when saving through these personal pensions, workplace pensions?
Great question, Doug. So, in short, I'd probably say there are three main factors that drive your pension pot and its growth, and inevitably how much you've got in retirement when you retire. The first one would be how much you're paying into it, so your pension contributions. So that might be personally, it might be your employer's pension contribution, or even if you're your own your business, it might be your business's contribution. And effectively, the more you put in, the more you are likely to have when you come to retire. So contributions is a big one. The other main factor would be its average investment growth. So if you're starting out and you've got a really long time until retirement, 40, 50 years, just imagine the effect of, say, an average 5% annual growth rate on your pension pot over time. And how if you tick that up slightly, or again, have a slightly than below average return on your pot, how that might affect your total over time. And then finally, charges. So again, to state the obvious, I suppose, the more expensive it is, the more charges you will pay, and therefore the less you may have in retirement, and vice versa. The cheaper it is, the more you keep in your pension piggy bank, if you like. To give you a bit of an idea, a default fund in an auto enrolment workplace pension is mandated not to have higher charges than 0.75% a year. So if you're in a workplace scheme with your employer, it's likely to not go above that charge. What I would say actually nowadays is most workplace pensions, if they're in larger schemes, they actually tend to attract even lower charges than that. So it might be that you're paying less. The personal schemes tend to be a bit more expensive, maybe more than 0.75, perhaps 1%. Again, it depends how you're invested, who you're with. But that gives you a flavour. And effectively, you want to try and keep that charge proportionate to the value that you're getting from your pot. And I'm sure we'll probably come on to speak about that in more detail later on, Doug.
Engagement is so important when it comes to your retirement planning because it seems so far in the future. It's so easy to put off, but as you get older, time moves very quickly, and of course the planning you put in place earlier, the better the outcome will be. Because of course, if there is something that you need to tinker with, doing it earlier will have a much more profound impact. And the reason that this is getting such a complicated subject now is that people move jobs a lot more frequently. Longer the days are whereby you join a company fresh out of school and you stay with them for 30, 40 years and they look after you in retirement. Nowadays, we move around quite a lot in terms of employment. The average person has 12 different jobs in their lifetime now. And with auto enrollment encouraging more people to sign up to the pension, that's up to 12 pensions the average individual could have. You could potentially have more. So it's all about understanding where your pensions are, who your pensions are with. And with modern technology now, it's getting better and better. I know for our workplace pension, we have an app which is fantastic. Some of the not so developed pension providers, they might have an online login that you'll be able to use. Either way, it's all about finding where your pensions are, because there is, would you believe it, 26.6 billion reported to be in lost pensions at this moment in time, which is just mega money. So if you do have any lost pensions, the first port of call is track those down. Don't be ashamed to dig your shoebox of shame out with all your paperwork on, and get that spreadsheet, get all your providers and your policy numbers all in one place. If you have lost any pensions, there is the government-backed pension tracing service, which I would recommend using. Type it into Google, lost pensions. Don't click on the first couple because they're adverts and they'll charge you. Go down to the .gov.uk website and find out where your pensions are. So once you've done that, you're now in a position to move forward managing your pension. So Nicola, you know where all your pensions are. I'm sure you do. Or if a client comes to you, says, right, I know where they are. What do I do next? What do you talk to individuals about?
Yeah, so some really helpful tips already there, Doug. But yeah, certainly if someone asks me that question, I think it very much depends on how old they are, where they are in their journey. I suppose for those just starting out, maybe in their 20s or 30s, the first thing I would say is just get started. Start building your pension. When your employer offers you that scheme, don't say no, take it. The earlier you start, the easier it's going to be for you to build your retirement pot. Um, if you're just beginning on that journey, it might be that you're starting off with a scheme where you are offered the auto enrollment contribution requirements, or minimums, if you like. And for most people, that means it's about 3% from the employer and 5% from the employee that comes from your salary. It will vary, of course, depending on whether you're employed or self-employed, and various other elements to your situation. But as a general rule of thumb, for most people, they'll have an auto enrollment scheme available to them, and I just really encourage you to take it. And don't forget to consider those employer contributions. So again, most people who are employed, if they contribute a certain amount, let's say 5% of their salary to their pension, it's most likely that your employer is going to, at the very least, offer you the minimum contribution, being 3%, if not more. Most schemes will actually offer you, perhaps you could say, a tiered or sliding scale, that the more you put in, the more your employer may match or further enhance their payment to you. And that really just builds your entire, remuneration package, if you like. The more you're putting in, the more they're giving you, and therefore the more you're actually being paid overall. So just take the chance when you get it. And if you are self-employed, probably leave that for another podcast. But just start with a regular personal pension. And then, for those later into the journey, well, I suppose it's a little bit more nuanced, the answer I might give. One of the things I'd probably talk about is the increasing tax benefits that they'll receive by putting more into their pension. So for just to run through that briefly, any money that goes into a pension in the UK will receive tax relief at your marginal rate. So if you're a basic rate taxpayer, that's 20% tax relief. Higher rate taxpayer, that's 40%. And for an additional rate taxpayer, it's 45%. There are also some caveats and nuances involved there, but in general, that's what applies to most people. So let's just take a basic rate taxpayer. Just give a very simple example. If you're putting in £80 per month, the government will give you an extra £20 per month of tax relief to round you to your £100. That's your 20% basic rate tax relief. And what I would say, as you're building your retirement journey up and you're approaching retirement, another big factor really is that you perhaps can afford to put in more. Perhaps you've paid down some of your mortgage. Perhaps you've your children have grown up and left the home and you've got a little bit of excess income coming in, you're also more likely to be a high rate taxpayer by that point, because you've really enhanced your skills and honed your skill over time. So the more you can put into your pension, the better, the more tax relief you'll also receive. And furthermore, the closer you are to your normal retirement age, and i.e. the time in which you can take your benefits. So the more you can put in at this stage of retirement planning, the better, really.
Yeah, that's such a good tip for individual saving for their retirement. If you're getting close to your retirement and you've got excess income because your career earnings are high, or hopefully at their highest point, the mortgage is paid off, the kids are financially independent, you want to be throwing as much into the pension, getting that maximum amount of tax relief before you come to retirement, because it could be the case that you can access those benefits anytime that you want. So it's a no-brainer to throw as much in as possible. Of course, there is the annual allowance that will caveat that current legislation, you can only contribute a maximum of £60,000 a year. But that is a really, really good tip if you're close to your retirement date and you've got that excess income. So a common question that I always hear, Nicola, is people that say, and I'm going to stitch you up with this one because there's no black and white answer.
Be kind to me, Doug.
So, how much does an individual need to save in their pension pot for retirement? How much income do they need in retirement? Take it away.
You're absolutely right. It's such a common question, and I get asked it by such a variation of ages as well. So there's lots of ways to look at that and answer that question, and we've only got a short time today, so I'm just going to give you a bit of a flavour. Okay, so one way to look at it is perhaps, I suppose, statistically, what the average person in the UK might need. Lots of surveys have been done over the years. To maybe mention one of them, the Retirement Living Standards survey conducted some independent research, and they looked at what a typical picture of retirement might look like and sort of what levels of income you might need to have, say, a moderate lifestyle in retirement. And in the UK, for a couple, at the moment, that those statistics suggested you needed about £43,100 per annum to achieve a moderate, standard of living retirement. Those looking for a more comfortable standard of living, the research showed that you'd probably need nearer £59,000 as a married couple in the UK, or not even married for that matter. Actually, could be cohabiting. It depends. Depends how you're, planning your retirement together. So that gives you an idea. Another really quick rule of thumb that I'm sure, Doug, you're the same. Variations of this have been used throughout the years, but somewhere between 50 to 70% of your annual income now might be an idea of what you may need in retirement. The reason it's not 100% of your living standards now is just because by the time you retire, most things like mortgages, perhaps some debts, responsibilities for children, they tend to be nearing being finished, and therefore, again, your expenditure levels do sometimes drop to accommodate that. So hence that rule of thumb somewhere along those lines exists. But what I'd really, really, really encourage, and what I do when I'm with my clients, would be to actually find out your personal, your bespoke, specific number. And in short, the way to do that is effectively to put a bit of time aside, maybe take like a rainy winter evening, and go through what your current expenses are. So your food bills, your utilities, mortgage, maybe your average spending on holidays, everything that you as a household tend to spend on. Once you have that figure, and probably go from a monthly basis, and then you can extrapolate that to an annual basis, what it currently costs you to live. And that is a really good starting point for this type of planning, because once we know what it currently costs you to live, we can then figure out what things might drop off by the time you get to retirement. I've already mentioned some of those. And more excitingly, and the bit I love, are the bits that we add into that puzzle. So maybe you're going to do, a year's travel around the world. Maybe you're going to spend some more time with your in-laws up north. Maybe you're going to take up that golf membership you've always wanted. Often there are increases in leisure spending, and again, it's good to add those to this potential projection. And once we've got that, we have a really good understanding of what you're aspiring to live off. And we can use that to figure out how much you need to build in your pension pot when you come to retire. And I would really just pause there and take a moment to take that in, because I don't think people always necessarily appreciate it. If you think about how much, how hard most of our listeners are probably working now in order to bring in the income they currently have and meet all their expending needs, when it comes to retirement, you've got a picture that at one point that income's going to stop, and you need to continue delivering that level of income for the rest of your life, be that 30, 40 years. I suppose it depends when you retire and various other factors. That's a really significant amount of saving you've got to put away to get there. So hence why this podcast and why this topic is so important. Now, if you've got me there to help you, then that's fantastic, or Doug. But if you don't, then you might want to look at some other avenues for figuring out sort of that income that you're projecting and how to get there. One of them would be using online calculators. So there are some government-backed and also provider-specific money calculators. One website I know provides it is a website called Money Helper, and that's a government-backed website. The other way of looking at, if you're on track, would be looking at your provider pension illustrations. So don't shy away, listeners. I'm sure many of you get those in the post every year. Maybe they go into that file that Doug was talking about earlier. Try not to ignore them. Please do look at them. They will, in that annual review letter, it will usually have a page there that projects what income you're on track to achieve at your target retirement age, depending on where you set that. That will give you a flavour of, again, what you're probably heading towards in terms of income and retirement. And if you've got quite a few different pensions, it might be a case of adding those projections together. And then I suppose probably the most useful in my mind, and Doug, I'm sure you'd agree, is you do have the benefit of having a financial advisor. Then cash flow planning can be a really good way of projecting if you're on track for your desired retirement. What I would say is just a really big warning message at this stage to say all these types of calculators, illustrations, cash flow, all of them use assumptions. So, for example, an assumed growth rate of 5%. If that assumption is quite far off, either too high or too low, you can imagine over time how that could really potentially be over or under projecting what you may get in retirement. So although they're useful tools, just take them with a pinch of salt and keep reviewing it every year to make sure you are on track. So now we have an idea of our target income in retirement and why it's so important to stay on top of that. Doug, what else do you think individuals could do to boost their income and retirement savings?
Well, yeah, absolutely. Once you can contribute as much as you can contribute, of course, you don't want to put yourself on the breadline by throwing everything at the pension. We can also get the pension working a bit harder for you as well, because once your contributions are allocated into a money purchase personal pension, they're invested into the stock market on your behalf, and any investment growth achieved is tax free as well. And we all hear stories of companies doing fabulously well in the stock market and companies not doing too well in the stock markets. So how are you actually invested? All pension schemes will have a default investment strategy, and if you don't make an active decision, this is what you'll be invested into. Now, best practice default investment funds, they're typically around about medium to high risk at this moment in time. If you're 20 or 15 years away from your scheduled retirement date, and consist of numerous equities, company shares, could be government gilts, loans to the UK government, corporate bonds, loans to multinational companies, maybe gold, maybe property. They're really, really, really diverse. They're quite boring, they're quite vanilla. That's what you want. You don't want to double your money overnight, but have the potential to lose your shirt. You just want to achieve that 4, 5, 6% net of charges return year on year, because you are going to be counting on this money in retirement. So, with default investment strategies, what you could look to do is change that investment strategy to suit your needs. So, for example, if you're young and you've got a 20-year investment horizon, you can perhaps be a little bit more aggressive. Likewise, if you're very close to retirement, you may want to take your foot off the pedal slightly and be a little bit more defensive. In 2007, 2008, in the financial crash, what we saw is a lot of people delay their retirement because their pension funds fell in value. Nowadays, there is investment lifestyle in that should taper off some of that investment risk, but it is very much a one size fits all model, and it's changed dramatically best practice since I've been in industry over the last 15 years. So be careful. But with all pension funds, you will have a level of investment flexibility, typically between 200 and 300 different investment funds for your basic group pensions. If you transfer to a SIP or a more sophisticated pension, it could be 2,000, 3,000. It all depends on the level of involvement that you want. But it's so important to get the level of risk right. And what we mean by risk is the volatility. Are you happy to take higher levels of day-to-day volatility in exchange for a higher aggregate return over the long term? So with my pension scheme, I'm sadly quite a far away from retirement. I'll need to be working for a long time. I've put my risk up. I'm a little bit more aggressive because I don't mind if the stock market falls heavily in 1 year, providing I get that payback the next year. What I would say though is if you're not very knowledgeable, remain diversified. You don't want to be looking at, right, what fund did the best over the last 12 months? Because typically the best performing fund over the last 12 months will be the worst performing fund over the next 12 months. So just be globally diversified and invest in the right level of risk, because with the power of compounding, if you're getting even a marginal level of increase year after year, after 20 years, that will be significant. Likewise, again, if you're close to retirement, you want to protect your fund from those potential downfalls in value. So do have a look at the investment flexibility. Do talk to someone about this. Do your research and set it up in line with what's suitable for you. Just be aware though, changing the investment strategy could change the charges slightly. I think you mentioned earlier, Nicola, that the workplace pensions, these are capped at 0.75% for default investment strategies. But don't be scared of slightly higher charges, providing there's value in paying those higher levels of charges, whether it be a more suitable level of investment risk, or even that the pension's a little bit more sophisticated and suits your objectives more closely. So this brings us on to another common question. Transferring pensions, Nicola. Can we transfer pensions? Is it worth transferring pensions for ease of management, investment flexibility? Well, how do we go about that? Is it worthwhile?
Yeah, consolidation, is it worth it? I am asked it all the time by my clients. So, and as with many topics, the answer is it depends. So some of the benefits of consolidation, I think one driver for that certainly would be ease of management. There's no doubt about it. If a client's got that average of 12 pensions over their lifetime from 12 different jobs, as you mentioned before, then actually staying on track of those can be a little bit difficult. And if you are approaching retirement, it might be a little bit easier to manage in the one pot. That's a really good reason. But you don't want to discount some of the other either benefits or negatives to it. And another benefit would be charging. So nowadays, there's some really competitive charging models out there, and you may benefit from combining your pension values together in order to benefit from a tiered or discounted charging structure with a provider. So many providers will effectively bring down their product charge, if you like, depending on the value of your pension investment. So that can be a really good money saver for some. Another driver or benefit might be things like your fund choices. So you just mentioned that a little bit there, didn't you, Doug? The more modern, sophisticated pension may have thousands of sort of fund choices to choose from. And for some people, that might be a good reason to move. I think another final benefit would probably be ease of access. So it's going to depend on how old you are and how old therefore your pension is. But some pensions may not have the level of flexibility that you want when you come to take your pension benefits. And again, transferring your pension to a more modern scheme that gives you full sort of access to the various different ways of withdrawal, that can be another reason. So they're all good reasons to transfer, and yes, you absolutely can. Some of the downsides to be aware of. Do check for transfer penalties, exit charges. Again, this tends to be older style pensions, but they are out there, so tread carefully. You could also inadvertently reduce your diversity. So reduce your diversity of provider, reduce diversity of investment fund selection. Something to be mindful of. If you're seeking advice, then you'll probably be okay, but it's just something to monitor. And then I think probably the biggest thing to bear in mind is going to be the accidentally foregoing or giving up really good benefits. So in the industry, these are called safeguarded benefits. They tend to occur, or you tend to have them if you've got a pension prior to 2006. There's lots of weird and wonderful legislation changes that have occurred up till then. It can give you things like guaranteed growth rates, enhanced tax-free cash. It can be quite difficult, I think, as a lame person to spot those. So I would just really tread carefully. You don't want to give anything valuable up. And really, it's all about balance, isn't it? So that answer, it depends. Well, depending on your situation, we would need to look at all those different factors I've just laid out there and effectively come to a conclusion as to whether you're going to benefit or not. And the answer will depend on your circumstances. So just do your research before you combine. But yes, it can be really beneficial.
I think another thing people need to be mindful of as well is there a cost to transfer?
There can be. So, there can be exit penalties sometimes from your providers. Again, that tends to be on the older style pensions. If you are engaging with financial advice, there can be a cost for financial advice. So yes, there can be costs for amalgamating your pensions, but not always. Not always. So we've got quite a lot today, Doug, haven't we? So maybe we should leave the listeners with a few other tips for managing their pensions. What are the tips you tend to go through with your clients?
Yeah, a real common one is to complete an expression of wish or a death benefit nomination form.
Mm,
It's both the same thing. There's two different names for it just to confuse you. So with your pension, it's not a use it or lose it situation. This is your private pension. State pension, that is use it or lose it, unfortunately. But your private pensions, in the event of your death before the age of 75, that will be paid down to your beneficiaries tax-free under current legislation. So what I would recommend our listeners do is complete that expression of wish or death benefit nomination form. And that provides the pension trustees with instruction on where they should be paying those pension benefits. It's free to do. There's no charge. You need to complete an application form to do it and make sure it's up to date. With modern families nowadays, you don't want to be leaving it to your ex-spouse or anything like that. So do make sure it's up to date. That's my first top tip. My second one would be, again, going back to the investment, understand if there is investment lifestyle in, which could affect your pension policy. So this has really come into play in the last 5 years or so, under best practice to, as I say, taper off that investment risk as you approach your scheduled retirement age. That's sometimes 65, sometimes 67. Unfortunately, it is the right thing to do because it protects investors that take no interest in their pensions whatsoever. Not like our listeners that obviously are listening for a reason. Um, but it's a one size fits all model that typically fits no one. So do be aware of that, because if you're approaching, it's typically kicks in about several years before your scheduled retirement age. So do have a good understanding of what that means. It's the most common time that we, or I personally receive initial inquiries for clients, because this is such a key age to understand, right, what pension benefits have I got? What will they provide me? And uh, I've got enough time to actually make those changes, pick up on those tips, like increasing your pension contributions to boost your income in retirement. How about yourself, Nicola? What are the common questions you get asked, and what's your top tips?
Yeah, I mean, and just you saying that, to be honest, it made me think of a couple clients of mine recently, who unfortunately I've noticed have been accumulating in cash for several years. So just to add to that lifestyling and target retirement age fund tip from Doug, do make sure it's invested one way or another. You don't want to be sitting in cash and paying charges for it. So yeah, some other questions I tend to get asked. Actually, quite a few people ask me, when can I take my pension? Not always that obvious. So the private pension age is currently age 55, but in 2028 it's going to increase to 57. So that is the age that you will be able to take, or the minimum age rather, you'd be able to take your private pension savings from. But, typically people tend to access it nearer 60, 65, sometimes later. Just be mindful, of course, the earlier you take your pension, the less time it's going to be invested, or the less benefit of contributions that scheme will have over time. Another one to probably keep on top of, I would say, is informing and updating your pension providers. So, if you're moving house, if you've moved job, maybe you've got married, you've had some life events, your name has changed, your contacts have changed. Please do update your pension providers. I've had many clients through the door over the years who, think back to when they were in their 20s and 30s, when they used to work for X company. They've moved address several times since then, and they don't know where their pension is. Not only is the individual moving, but to add to that, and in this industry, in this industry, we see that pension providers often consolidate and move around over time. So I would not be surprised if many of our listeners currently have, a pension that perhaps used to be with Friends Life and now it's Aviva, and vice versa. So keeping on top of where they are and them keeping on top of where you are, I would say, is really important. Save yourself a big headache later on in life. Same goes for the nomination forms that Doug just mentioned there. It might be that who you wish to benefit from your pension when you pass changes. So just make sure you keep that one up to date.
Yes, that's a common question that I get asked. What happens to my pension when I leave my current employment or
Yeah.
employer? And the simple fact is that is your asset. The link with the employer is severed, and it is your asset. Typically, you'll receive a leavers letters afterwards saying, "What would you like to do? Transfer, start making personal contributions, or leave it where it is." And there's no disadvantage as such by having multiple pension schemes, although, as you've discussed, there is benefits of consolidation. But that is 100% your asset. So you want to keep an idea of what's happening with that. Update your personal details, as you say. I'd like to add as well, always with financial products, be careful of scams. It seems so obvious, but they get more and more sophisticated each year. So do be wary of that. Of course, if anyone contacts you out the blue in terms of your pension or tells you that you can take your pension out at age 25, they're not telling the truth. So do please be aware of that. Um, Lastly, Nicola, before we let everyone go, for those individuals starting out on their pension journey in the middle or coming towards the end and close to retirement, where can they go for additional support, additional help, additional guidance?
Yeah, so there's probably quite a few different areas you can call upon. So first of all, if you're in an employer scheme, it might be that you have workplace sort of a pension specialist or advisor provided by your workplace. Maybe you have some employee benefit packages or financial well-being clinics that are offered. That is something worth exploring. Tends to be more likely if you're in a larger company. But yeah, something certainly to check in on. Other than that, there's some helpful government-backed websites such as MoneyWise, Money Helper. They can be really useful for some good pension information. And then outside of that, we've also got privately ran websites that again got to tread really carefully, but there's some really helpful ones. I know myself, I often use Martin Lewis's Money Saving Expert website. Some really good tips on there. And there's lots of good pension provider websites that also provide really useful information. What I would say is when you're looking for factual pension advice and information, just tread really carefully. A bit like Doug has just mentioned, the scams are becoming far more sophisticated. For example, let's pick on Martin Lewis, but I know that unfortunately his name and his face has been used and sort of amalgamated to by scammers and websites that aren't there to do you any justice. It can make it really difficult to tell which ones are legitimate, which ones aren't. So if you're unsure, then please just check again, check where that website is based, and really be careful about using information from social media platforms like TikTok and Instagram and various others. There can be some useful content on there, but they may not be regulated financial advisors. So again, just take it with a pinch of salt, and tread really carefully. And then sort of putting that to the side, of course, financial advice. So myself, Doug, any member of the Integrity365 team, or for that matter, any other financial advisor, they are there to help you, to provide advice. Good advice should pay for itself. So yeah, don't be afraid to consult a financial advisor. It's not there just for the ultra wealthy. It is there for all individuals, wherever they are in their journey. It's just the matter of finding the right person for you, and it's a really personal decision. But please do use the expertise of a professional.
Brilliant. Thank you very much, Nicola, for all your input today. I'm sure all the individual listeners to this podcast will find it extremely, extremely helpful. And that's it from today's episode. Don't forget, you can hear more from Integrity365 on our social channels on YouTube and Spotify. We have also just released 2 new PDF guides on managing your pension and tax-efficient pension planning, which you can download via our website or request from the team. That's all. Thank you very much for joining us today. I've been Douglas Sims with my colleague Nicola Glass. Thank you all for listening.
Thank you.